Hello, everybody. Okay, so I have been swamped with emails and phone calls from everyone wanting to know, what do we do? The interest rates are going up. Do I fix? Do I sell? Do I refinance? Is the property market going to crash? A whole bunch of different questions. I've recorded this video to try and put things in a little bit of perspective and just bring you up to date with what's going on. I had a whole heap of slides. I've really tried to cut it down. I'm going to pump through them really quickly. If you want some more specific advice for you, please reach out. More than happy to help you all. The easiest way to get me is via email. The phone just rings off the hook all day. So please try and stick to email. Matt, I'd like an appointment, something like that. Or one of the marketing team probably even have a landing page where we're getting bookings in. So there should be a link down below somewhere to book an appointment. All right, so very first thing, you're going to be okay. The reason for that, or the main reason, is after the GFC, so after America fell off a cliff a few years back, there was a bunch of reviews done, and it wasn't just over there, it was done in Australia and a whole bunch of different countries. Australia specific, there were a few extra stress tests that were added to the bank calculators back in, say, 2014-ish, 15, and they've continued to swap and change slightly. But what it means is, when you got your home loan approved, it wasn't whether you could afford the repayments at 2% or 3% or whatever the interest rate was when we got you the loan. It was, can you afford the interest rate when rates go back up? So the bank looked at you and said, all right, if we loan you all this money, you can obviously make the repayments. That's the easy bit. What happens if rates go back up? And so they have this thing in their little calculator called an assessment rate. Now, all of you, when you got your loans approved, you would have passed the assessment rate at somewhere between, say, 5.5% and 8%, depending on the bank and the type of loan that we got at the time. So the first thing is the bank assessed you before they gave you the loan, and you all passed at higher interest rates. So there should be no need to panic. There should be no need to panic is basically the long story short. All right, reason not to panic number one. Can I get rid of it? Oh, there we can. I can. Look at that, modern technology. All right, so reason not to panic number one, we've all got jobs. And if we've all got jobs, it means we've got money and income. So it doesn't matter which way you look at the employment situation at the moment. The unemployment rate is generally the one that we're looking at. It's sitting around at like 3.9 or something at the moment %. So basically means everyone's got a job. If everyone's got a job, then everyone's got money. If everyone's got money, they can afford to pay for things. As a nation, the blue line basically represents our household disposable income, which is the money that we've got to spend on stuff. And the red line is what we're spending it on. So the important figure is the blue line is higher than the red line. So we've got a bunch of money. Yes, the price of things is going up, but we've also got a lot more money than the price of things. So that's the second bit. Number two, spending momentum may be moderating. All right, so, whoops, how do I go back? These figures, I was in an economic briefing on the Tuesday a couple of weeks ago when the RBA increased its rates. And we were having a chat about some of these graphs at the time. These are basically a couple of days old at that time. So they're pretty up to date. And what it's looking at is the Commonwealth Bank credit card spending tracker. So the figures are really live and up to date. And what it's showing is here, you can see it's starting to drop off a little bit. That's probably because the month prior, we had the first interest rate hike. Then there's all these news stories, oh, interest rates going through the roof, et cetera, and everyone's starting to back off on their spending. That is the whole idea of this. What the Reserve Bank wants is for people to stop going out and just spending money willy-nilly and driving prices through the roof. And you can see here, it's started to back off already. Household to debt. All right, reason to not to panic number three. As a nation, Australians basically have more debt than all of our other peer economies. You can see here, New Zealand, UK, US, Canada. We're way up here with more debt than pretty much everyone. And we've been like that for quite a long time. So what that means is, don't look at news.com.au and look at America and what goes on in America and then refer back to Australia as though that's going to happen here. There are a lot of similarities, but there are also some big differences. And you can see here, there are some massive differences in terms of the amount of debt that we have in this country. And what that means is you get a lot more bang for your buck when the Reserve Bank raises interest rates. And what I mean by that is when interest rates go up, it has a big impact on us. So our repayments get more expensive. When our repayments get more expensive, what do? Where'd it go? Our repayments get more expensive. We stop spending money on clothing, recreation, and eating out. So that's the whole point. And then over here, you can see consumer prices. So this is what the Reserve Bank is referring to when they're talking about inflation. What they want is for inflation to remain in this grey band here, about 2 to 3%. They want prices to go up over time, but they want them to go up very, very slowly and gradually. What you can see here is over the last sort of 12, 18 months, prices of pretty much everything has gone up really, really quickly. And so what they're trying to do is get these lines back down here in the grey. And the way that they do that is they increase interest rates so that your mortgage repayments get more expensive. And what happens when your mortgage repayments get more expensive? You spend less on clothing, rec, and eating out, and a bunch of other stuff, but they're the main things. And when you spend less on that stuff, it means the graph, as you can see, it's happened in the past, it comes back down to where it's supposed to be. And that is what they're trying to achieve. So that's reason not to panic number 3. They're trying to get this back down here, and you can see these live figures, looks like it's already starting to happen. Reason not to panic number 4. I'm getting a lot of questions about, is property going to collapse? We're going to lose 20, 30%. Should I wait a couple of years to get in? That sort of thing. The value of property changes over time. There's many factors that impact on what drives prices. One of the obvious things is just supply and demand. So on the demand side, you can see here, this is the interstate migration for different states in Australia. Now, Queensland has a long history of having an increase in migration when things get bad. And you can see here in the early 2000s, the dot-com bust. So people left New South Wales, which is why their number went down, and they moved to Queensland. And then we had the GFC in 2008. New South Wales population went down, Queensland's went up. And then we had COVID. New South Wales population went down, Queensland went up. So if there's a whole bunch of people moving to Queensland and you're going to open homes and either for rentals or to purchase, you would have been seeing lots and lots of people there all competing for the same properties. That's basically what's been driving the prices up. One of the reasons driving the prices up. On top of that, we've got the net migration figures. So Australia so this is Queensland, and most of you are going to be in Queensland. Obviously, there's a bunch of you that have property in other states as well, but the bulk of you, we're going to be looking at Queensland. Net migration. So when COVID hit, you can see here, the population of Australia didn't grow. But once the borders have opened up, people have started reapplying for visas, coming back, going to university, work visas, etc., and the population started to go back up again. Now, depending on what figures and what articles you read, the latest figure I've come across is 163,000 new people coming into the country. We need to give them a house. Where are they going to live? And so those extra people, they either have to rent somewhere or they have to buy somewhere. Either way, they're creating more demand for housing. So if your question is, are housing prices going to collapse? I'm sort of presenting this to you and going, well, if house prices are going to start dropping off, yes, they might drop off, but there's going to be tens of thousands of people, if not hundreds, trying to buy houses that have been too expensive, and then all of a sudden they've been going to open homes. Now they can get one, they're going to get one. Next one. Okay, fixed and variable rates. Now, traditionally or historically, if you go back to say June 2020, and these figures are for Commonwealth loans, which is where I got these figures from, heaps of people were on variable rates. So you can see here, there's a whole bunch of blue, and this would be representative of what's happened over across most banks. Most people are on variable. There was only a small percentage on a fixed rate. Now, when you look at December 2021, there's a lot more that have taken out fixed rates. So if we're talking as an economy as a whole, a lot more people have fixed rates. So if interest rates go up, it's not necessarily impacting everyone all at the same time and causing us all to just fall off a cliff and the economy is going to collapse or anything like that. It means these people will be impacted, And then these people in the red, they're going to be impacted in the future. Now over here on the right, you can see here, some of them are going to roll off their fixed rates this month, some in December, some in June next year. December next year is when a whole heap are going to be rolling off fixed rates. And then you can see here, as fixed rates have become more expensive, there's a lot less people taking the fixed rate options. And so that's why it's dropping off here. Dwelling prices, okay. Now the important thing with this particular graph is to remember this is not the actual price of property. This is the change or the percentage change. It's a 3-month rolling change. So what it means is when things are going up here, it's meaning that the value of property is increasing by, say, 2% this month compared to 3 months ago. And so you can see prices are going up quite rapidly. Now you can still see we're at what, 4-point-something% roundabout for Brisbane. Prices are still going up. Just because the graph is going down doesn't mean that prices are falling. It means they're rising because it's over zero. They're rising by a smaller percentage. So it's growing at 1% or 2% or 3%, 4%. With the other capital cities, you can see here, Sydney and Melbourne, they have dropped. So the percentage change has decreased slightly, and you can see it decreasing by 1 or 2% there. How long that lasts depends on a whole bunch of factors. We can go back to these slides. You can see here, New South Wales, obviously, a lot less demand for those properties compared to Queensland, where there's a lot more demand. All right, reason not to panic number 7. Just because rates are going up doesn't mean they're going to keep going up. They will, I'm not going to give any predictions. There's more than enough predictions in the news, and a lot of that is doomsday stuff. The important thing to remember is the rates are going up to try and slow spending. Go back to this graph here. Where is it? Rates are going up to try and get these figures back down a bit into this grey band. So as rates go up, like they did in the last GFC, they came back down. And you can see it just repeats. It's just repeating. It's happened over and over again. You don't need to panic. All right. Commonwealth believes that the RBA will put rates up to about here, 1-point-something%. The rate that we as customers get is usually a couple of percent higher than what the Reserve Bank rate is. So these rates up here, sort of 3.5%, 4%, is probably, not probably, is what the Commonwealth Bank, for example, is expecting to occur. I'm trying not to drag these slides out. I'm trying to get through them quickly because I don't want to bore you with PowerPoint. There's a whole bunch of reasons about that and why they believe that. And basically it comes back to, as rates go up, how quickly is inflation going to get back under control? Once again, I'm going to backtrack on the slides. Is all this spending that we've gone through, this spending here, is it going to come back down to manageable levels? Back down so that it's only growing at 2% instead of 5, 6, 7%. Now, you may have seen a news story. The RBA governor's come out and said, he expects inflation to hit 7%. So we're going to be up here somewhere. Obviously, that means interest rates are going to keep going up until spending gets under control. Is spending coming under control? This graph would suggest that yes, it's starting to have an impact. So in your minds, are interest rates just going to keep going up for the next 20 years? No, they're not. They're going to go up until these numbers come down back into this range here. Okay. I like to use the analogy of fuel prices. So if we just pause this screen for a moment, and if you just imagine fuel prices, we're roughly paying about $2 a litre for fuel. And so consider that a variable fuel price, just like your variable interest rate. If you take a fixed rate, it's a little bit like getting a fuel card that locks in the price of fuel per litre for the next 2 years or the next 3 years, whatever it might be. And so what you would be, the analogy would be, if you, rather than pay $2 a litre like it is right now, I'm going to buy a 2-year fuel card that says I can buy fuel at $3.50 every single day for the next 2 years. And it's not that you can buy fuel, it's that you have to start buying fuel at $3.50. And that is what's happening with interest rates at the moment. So you can see the variable rates are still low. They have gone up into the 3s now. But if we go and look at the current fixed rates, most of the fixed rates are in 4 and 5%. So you've got this choice. You can stay paying, switching back to fuel, you can pay $2 a litre and it might go up to $2.20 and drop down to $1.80, and over time it might head up and up and up. Or you can take a fixed rate, which means you can go to sleep every single night, wake up in the morning and go, my fuel's $3.50, doesn't cost me any more, beauty. And what you're doing is you are just buying certainty for a certain amount of period. So for the next 2 years, that is what the cost is. The reason that a lot of people do that is they think the price of fuel might be $5 a litre or $4 a litre. And so they think, beauty, if I get my fixed rate fuel card at $3 or $3.50 or whatever it might be, I'm gonna be ahead, sort of thing. Next slide. What can you do? All right, so have a backup plan. If you don't have one, make an appointment. It's pretty easy to do. We'll sit down, have a chit chat and go through your options. Start anticipating an increase in your loan repayments. So if you're on a variable rate, and even if you're on a fixed rate, the fixed rate is going to end. Go back to one of these slides. You're going to roll off your fixed rate in December or June or December, or whatever it is. At some point in the future, you're going to roll off your fixed rate. If you roll off your fixed rate, which is up here potentially, and the variable rate's down at 3 or 4%, then you're going to roll onto whatever that variable rate is at that time. If the variable rate is 7, 8, 9, 10, 20%, then you're going to roll off onto whatever that variable rate is at the time. Now, obviously, we can refinance, we can adjust the figures, we can swap loan types, do a whole bunch of different stuff. You don't need to panic, is the main point of today. Rates are only going to go up. I'm going to keep saying it and reiterating it. Rates are only going to go up until this spending comes under control and we get these lines back down here into this grey band at 2 to 3%, which is where they want it to be here. So have a backup plan, start putting some extra money aside. We do have the option to fix your rate. So we can do this, but remember the fuel card analogy. You may or may not be comfortable with this. The other thing to remember with fixed rates is at some point when we got your loan approved, I would have described or tried to get you to think of your loan not as your loan, but as a bank investment. So if you fix your loan, that is the bank fixing their return. They've got hundreds of thousands of dollars invested in you at 2% for 2 years or 4% for 3 years, whatever it might be. If you start making extra repayments or you want to sell your house because you've made a profit, that means the bank is going to lose its repayments from you, or one way or another, you're screwing with their fixed rate of return that they were expecting for the next 2 years or 3 years. So they're going to penalize you. So it's important to have a chat if you're considering fixing. Only fix if nothing is going to change for the next 2 or 3 years. And you don't want to make extra repayments, for example. If you want to take advantage of potentially lower prices in the future, you need to do it in 2 stages. Book an appointment. Okay, so what I mean by that is you can see on some of these slides that they're the property prices. Where do we go? Dwelling prices. Oh, goodness me, sorry. Right, dwelling prices. In some states, where did it go? Dwelling prices, goodness me. All right, so you can see the growth rate is dropping, and you can see some states have started to drop into negative growth. Once again, it's not a reason to panic. I didn't go into this in a lot of detail, but we're talking about the average price. So if you think there's a whole bunch of houses for sale in Brisbane, or Sunny Coast we'll call it, at a place like Mooloolaba, there's some really expensive mansions where you can pay millions of dollars, and there's been lots and lots and lots of sales at millions of dollars. At the other end of the Sunny Coast is, it's a good example, Blyby, Nambour, parts of Caloundra, across the highway out to Landsborough or whatnot. Those property prices have also been growing, but the cost of those houses are $500,000, $600,000, $800,000. And so when we bring up these graphs, or when economists and the RBA bring up these graphs, the numbers are always skewed somehow. So if those $1 million properties, if the volume of $1 million properties slows down, and there are more sales in the $500,000, $600,000, $800,000, $1 million range, then the average price of property is dropping. It doesn't mean that the $500,000 house is now worth $400,000. It means that there's, say, 10 houses worth 500. They could potentially be selling for more. They could be selling for 550, 600. But when we look on average, last month there was two $4 million sales in an expensive suburb. This month there's only one sale of an expensive house at $3.5 million. And so as an average, it looks like the total price of property in the area is dropping, but it could actually be that the more expensive properties, there's not as much turnover, but the cheaper properties could actually still be increasing in price. Whether that's correct for your particular area is a conversation that we need to have individually. But the point again is you do not need to panic because these lines are going up and down, right? They've been going up and down. You weren't panicking in 2016, 2017, 2018, we're down here, then it's up and down, up and down. Just my one piece of advice is stop reading news.com.au. It honestly, you'll sleep better, a lot of you, because I'm getting a lot of phone calls where you're quite stressed. Some of you have very valid reasons to be stressed. A lot of you don't. If you do feel stressed and you do feel like you need to have a chat about what's going on, you are more than welcome to make an appointment. I believe the marketing team's going to put a link here somewhere below. I'm still catching up with all this tech stuff and getting up to date. So this is my first hurrah into videos. To make an appointment. Right, so if you want to take advantage of stuff in the future, now there's a whole bunch of stuff we can do, right? So if you think, and you are very valid in this thought, that rates will continue to go up, the assessment rates will also go up. So the stress testing will go up. So as rates go up, it means your borrowing capacity is going to go down. So if you think property is going to drop in price at some point in the future, and you want to take advantage of that, you need to be aware that the amount of money that you can borrow in the future will be less. So you might not be able to take advantage of it like you are thinking and planning. So if you want to come up with a plan to be able to do this, and you're not in a rush, there's some really, really simple things we can do. We basically just need to do it in 2 stages. We need to make sure that we've locked in your existing equity now in today's calculators, so that in the future, when you want to snap up a bargain, potentially, then you've got the ability to, okay? Once again, everyone's individual. You've all got different incomes, salaries, car payments, kids, ages. Book an appointment, have a chat, we'll get it all sorted. There's pretty much something that all of you can do. It's just that particular something is different for all of you. I'm going to stop talking. I could keep going all day. I promised the team I would keep this as short as possible. Have a lovely day. Look for the link below if you need to make an appointment. Email is still the best way to get hold of me rather than phone, because the phone goes off the hook all day. And I'll stop talking. Have a lovely day. Matt from Happy Finance. Bye.